People always ask me what they can do to save money on taxes. Well, this past tax season, I saw several clients save anywhere from $20,000 to $100,000 or more through one strategy that was implemented well that they set up during the year. Spend a few minutes going through this strategy with me and see if it's something that can work for you. Now, this strategy worked for these clients, and it didn't matter what type of income they had. They had anywhere from W-2 income to business income to investment income. It offset all of those types of incomes and saved them $20,000 to $100,000 or more in taxes. My name is Merrill Taylor. I'm a CPA. I've been preparing taxes and doing tax strategies for over 20 years for clients. This one strategy that we're going to go through today is probably one of the most powerful strategies I've seen. The nice thing is it's 100% completely legal. It's not aggressive at all. As long as you meet the requirements and you fit into the rules, it works extremely well. And it's one that I talk about with clients and others all the time because I've seen the power of how this works. Now, what the strategy is called is the short-term rental strategy. So it is buying real estate, and if that puts you off, just stay with me for a minute and hear out how the strategy works and what it might be able to do for you. So what a short-term rental is a rental that is 7 days or less on average. So we're talking about like an Airbnb. When somebody goes and stays in an Airbnb property, they're not staying there for a month or longer. They're usually staying for a week or less. And as long as your average rental period during a year is 7 days or less, it's considered a short-term rental. The reason why that's significant is because when you have a long-term rental, let's say that you buy a home and you rent it out on a month-to-month basis, or you have an annual contract, but people are living there on average for longer than 7 days, well, that's a long-term rental, and it falls into the passive activity category, which means that any loss that you generate from that is considered to be a passive loss unless you meet certain requirements. You're under $150,000, then you could deduct up to $25,000. There's certain exceptions there, but most of our clients are over $150,000 of income during the year, and so that exception doesn't apply to them. And most of the people that are investing in real estate generally are over $150,000 of income because it takes some money to invest. So people that are making over $150,000, they don't have this this kind of caveat, or kind of this carve-out rule that applies to them. So it ends up that any loss that they generate from that rental activity is considered passive and actually doesn't help them at all on their tax returns. That passive activity loss just sits there and builds until they either sell the property or they have some kind of a passive activity income that comes that can be offset by that loss. So those don't work out really well. The short-term rental strategy works out much better because it doesn't fall into that passive rules as long as you meet active participation. Even if you have a long-term rental and you meet the active participation, but you're not a real estate professional, it's still passive. With short-term rentals, all you have to do is meet active participation and the losses can come through. So what do you have to do to meet the active participation, or what they call the material participation test? Well, there's a number of different rules. There's generally 3 main ones that apply, and those are that you worked 100 hours or more and no one else worked more than you. So you have to keep track of your hours and keep track of everyone else's hours that work on that property. So that would be handymen that come in, people that are repairing the property, people that are working on it, everybody that has something to do with that property. You have to track hours for everyone. People that come in and clean it, all that sort of stuff. If you got a property manager, what hours that they're spending, and generally if you have a property manager, you might not qualify for material participation because they're generally taking care of everything on the property and it's hard to get that. So that's the first one, 100 hours and more than anyone else that worked on that property. Number 2, you work 500 hours on that property. Now, if you own multiple properties, you can actually group them together. So if you work more than 500 hours on all of your short-term rentals, then you're considered to meet the material participation test and you can take a loss from that. The other one is that you did substantially all the work yourself. Generally is what we're looking at is that 100 hours and more than anyone else. Or if you just have somebody that's working more than you, then we're looking at that 500-hour standard. Now, it's important that you track your time when you're doing these. So come up with a really good way of tracking your time, tracking other people's time so that you can prove that. If you're ever audited by the IRS for taking a loss, the IRS is going to say, okay, let me see your logs, let me show, prove to me that you spent 100 hours on this property and it was more than anyone else, or 500 hours, whatever that you're using. Now, the benefits of the short-term rental is that if you meet this material participation test, then you can take a loss from that short-term rental. Now, generally, I know what you're saying. Why would I buy a short-term rental strategy that just generates a loss? Well, there's a really powerful deduction that comes with short-term rentals that can generally apply to the first year that you buy that, or whichever year you choose. You can kind of choose a year on that. And it is called the cost segregation study. So a cost segregation study comes in and says, okay, you own a building, so a short-term rental is depreciated over a 39-year life. So you take your purchase price of that, you minus out some that would go to the land, and then whatever's left over for the building, you get to depreciate. You can't depreciate land, but you can depreciate the building. That's depreciated over 39 years. But a cost segregation study says, okay, that's great. We got a building that's depreciated over 39 years, but there's components of that building that can be depreciated faster than that, such as flooring and fixtures and a number of other things that are inside that building. So a cost segregation study will separate out those components, and then you can take deductions on some of those components faster. Like flooring is like a 5-year life. Flooring is not going to last 39 years generally, like carpet and things like that. It's just not going to last that long. And so you can depreciate that over 5 years, and it's eligible for bonus depreciation, which means you can take a much bigger deduction the first year. Depending on what happens with bonus depreciation and the upcoming tax changes, it could go back up to 100%, which means any amount that's allocated to flooring could be written off 100% if the 100% bonus depreciation comes back again. Now, when we're looking at cost seg studies, usually anywhere between, say, 20 to 30% of that property generally falls into the life that we can depreciate faster or take bonus depreciation on. So, that means that if you bought a property for $500,000, you can generally write off anywhere from $100,000 to $200,000 with the accelerated depreciation coming through there. So that's a really powerful way of offsetting your taxes. And then, if you look at that, if you're getting, say, $100,000 to $200,000 write-off, if you're buying a $500,000 property, you usually only have to put like 10% down. So that's $50,000 in to get anywhere from $100,000 to $200,000 deduction. You're going to end up with more cash in your pocket than you put into that property, and you have an ongoing property investment that goes on after that. So that's a really powerful way. So that's the short-term rental kind of in a quick nutshell. We'll go into it in more detail in future videos, so make sure that you subscribe to catch those. But common mistakes to avoid that we want to go through is when you buy a short-term rental, make sure that you're tracking your hours in it. Since you're tracking your hours, make sure you don't outsource everything, that you're doing some of that work and doing it. And a really critical part is make sure that you're working with a CPA that knows short-term rental and knows that strategy. Most CPAs will just lump it in as a regular rental. They'll say it's passive. They'll kind of not do it the right way. So make sure you're working with a CPA that understands that and that can guide you and help you through that. And again, make sure to subscribe for future updates and go to taxtutor.com to subscribe to our weekly newsletter.